you can see that as far as the entire financial system in China, that is now angled towards gold prices, which are going to go higher and higher, driven by this amount of accumulated household savings, which sees gold as the way of getting out of their own currency. All this gold is just going out. It's just flying away from us. And why? Well, I mean, at the end of the day, it's because the majority of the world by population, or the central banks representing the majority of the world by population, is really dumping our currencies. This is a very serious point, which of course we don't really fully appreciate, but we will discover to our cost. We will wake up one morning and suddenly realize what the hell's happened.
For years, the United States has exploited its dollar dominance, often using it to address domestic issues while draining wealth from other nations and undermining their economic stability. This has accelerated the movement towards de-dollarization, particularly as the U.S. imposes financial sanctions that limit other countries' access to the dollar. In response, countries like China and Russia are seeking to lessen their dependence on the US dollar, especially through alliances like BRICS. They aim to trade in their own currencies, potentially reshaping global economic dynamics and diminishing the dollar's role in international transactions. According to legendary investor Alasdair Macleod, individuals in China are increasingly looking for safe investment options beyond traditional avenues like real estate, which have become less attractive due to market saturation and previous price drops. Although the stock market has shown some signs of recovery, its history of volatility has made it less appealing for many. Instead, with household savings representing about 35% of the country's GDP, around $6 trillion annually, there's a notable shift toward gold and silver as preferred means of wealth preservation. This growing interest in precious metals is reflected in heightened trading activity on platforms such as the Shanghai Gold Exchange and the Shanghai Futures Exchange. In June, China held 72.8 million troy ounces of gold, signaling a firm commitment to these assets. This trend could have significant repercussions for Western financial markets, where gold is often represented through paper contracts that may not accurately reflect actual physical holdings. With physical gold increasingly being withdrawn from vaults in places like London and the COMEX, Macleod highlights mounting concerns over supply shortages. The movement of gold from Western reserves to countries like China and Russia indicates a profound reallocation of wealth and resources. As central banks diversify their reserves away from the dollar, especially in emerging markets, we could see a major shift in the global monetary system and overall financial stability. We will present clips from Alasdair Macleod's interview, but before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for updates. Thank you, and enjoy the video.
Now, if we look at the Chinese situation in particular, we can add two further layers onto the problem. The one is the determination of China and its partners in the Shanghai Cooperation Organization and also BRICS to do away with using the dollar or depending on the dollar for their trade. The trade between them, the purchases of commodities, let's say within their club, their sphere of influence, they want to do away with that. So that's the first thing about it. Chinese nationals cannot hedge out of the Chinese yuan through any other mechanism other than buying gold and silver. Now, this is important because household savings are reckoned to be 35% of China's gross domestic product. And particularly when you see the gold price being firm, when you see the demand for gold, not just through these banks, but also through deliveries, or what they call withdrawals from the Shanghai Gold Exchange, and also growing speculative interest on the Shanghai Futures Exchange, you can see that as far as the entire financial system in China, that is now angled towards gold prices, which are going to go higher and higher and higher, driven by this amount of accumulated household savings, which sees gold as the way of getting out of their own currency. I think it would be wrong to say that Chinese individuals are buying gold because they see the dollar going down. They're buying gold because they see gold going up relative to other investments. I think there is a distinct possibility that this could lead to a crisis in Western capital markets, because when we deal in gold and silver, we are dealing predominantly in paper equivalents, which in theory are deliverable at the end of the day in gold or silver. But all the physical stuff is basically walking out of the door. I mean, you just look at the deliveries on COMEX. Virtually every day there are contracts stood for delivery, and we're talking about substantial quantities. Gold is also leaching out of London. It's more difficult to actually sort of, if you like, track the numbers there. But we just do know that all this gold and silver is just going out of the door, and it's no longer in our vaults. So where does that leave us? It leaves us with a huge, great problem. So there is a shortage of gold in official vaults in the West, which is unaccounted for. Meanwhile, it's all gone over to China and increasingly Russia, which started in this game only really at the time of the special operation in Ukraine and sanctions. At that stage, they stopped selling gold into the London market. All this gold is just going out. It's just flying away from us. And why? Well, at the end of the day, it's because the majority of the world by population, or the central banks representing the majority of the world by population, is really dumping our currencies. This is a very serious point, which, of course, we don't really fully appreciate, but we will discover to our cost. We will wake up one morning and suddenly realize what the hell's happened.
In June, inflation in the United States unexpectedly dropped to 3%, sparking optimism about possible interest rate cuts by the Federal Reserve later this year. This figure was lower than the anticipated 3.1%, down from 3.3% in May. However, as Alasdair notes, while the Fed aims to reduce interest rates to ease the burden of its significant government deficits, market conditions paint a different picture. According to a new report from the Congressional Budget Office, investor caution is growing due to concerns about the long-term sustainability of U.S. debt, currently around $35 trillion and projected to exceed $60 trillion by 2034. Alasdair highlights that interest rates are influenced by two main factors: global perceptions of the U.S. dollar and banks' cautious lending behavior during economic uncertainty. Many banks in Japan and Europe are highly leveraged, making them vulnerable to market shifts. Recent declines in commercial real estate have exposed further vulnerabilities, leading to tighter lending standards. This increased caution complicates the Federal Reserve's efforts to lower rates. While the Fed might attempt small rate cuts, these could backfire, potentially driving rates higher. Additionally, rising government deficits and an increasing money supply threaten the purchasing power of major currencies like the dollar, euro, and pound. Let's get back to the interview.
The point behind it is that the rates will be set by the market, not by the central banks. There's no doubt that what the central banks want to do is to get rates down. If the Fed could somehow manage rates lower and at the same time fund the US government deficit, then they will be very cheerful about everything. But the reality is they can't get rates down. Why? Because the market is telling them, you've got a debt problem. And that is actually going to set the whole thing. There are two basic drivers of interest rates. The first is the foreigner's view of your currency, and that is desperately important. And that is what we have been concentrating on when we talk about, is dollars going down rather than gold going up. And the second is that when banks turn cautious, then they will only lend at higher rates if they lend at all. The problem the banks have specifically this time round, it's a fluctuation that happens as part of the lending cycle. It's a 10-year lending cycle, which you can trace all the way back to whenever statistics were sort of semi-reliable. But basically, the banking systems are over-leveraged compared with where they would like to be. Typically, Many of the GSIBs, the global systemically important banks in Japan and also in Europe, are up to 20 times leveraged. By that I mean the relationship between total assets to equity. Now that sort of leverage basically means that it doesn't take very much in the way of losses on your balance sheet to wipe out your equity. And of course this is a topic which American investors have been made very much aware of with the commercial real estate situation, where values have collapsed and banks have outstanding loans, and they've got, they were lending as if it was a normal mortgage, sort of 80% loan to value type deal. Yet the values have collapsed to 30-40% of what they were. So banks have got huge potential losses, which they're finding extremely difficult to deal with. That is, so they're not in the business of lending money cheaply anymore. Yet they realize that if you get higher interest rates, then the zombified economies, these zombie companies are going to go bust. And even at anything a little lower than current rates, that is a process which is ongoing. This is that, we're going to find more and more businesses going bankrupt at anything like these levels. I mean, it's possible that the Fed might be able to lower rates by 0.25% or something like that, but I very much doubt if they'd even achieve that. And I would have thought that if they tried to do that, then the consequences would be even higher rates down the road. I mean, the idea that inflation is over, and which is the common story in the investment community throughout the world. I mean, it's a joke. Of course, it's not over. The idea that the purchasing power of the dollar, sterling, euro, whatever, is going to stabilize when governments are running massive deficits. In other words, there is more and more currency being created, diluting the purchasing power of existing currency. And then on top of that, you've got the subjective value placed on currencies in this situation by foreigners. I mean, there's only one way for this to go. I mean, and it's not good.
If current trends persist, we could witness a significant shift in the global economy. Countries like China are strengthening local currency trade and increasing their gold reserves, which may lead to a decline in the US dollar's dominance. This shift could result in rising inflation and economic instability in the US, while increased demand for physical gold might create volatility in Western financial markets. Share your thoughts on Alasdair's prediction in the comments section below. Don't forget to like this video, subscribe to the channel, and turn on post notifications for more updates. Until next time,